to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where Treasury professionals learn and share the information that matters most.
Hello and a warm welcome to the Open Treasury podcast from CTMfile. I am Pushpendra Mehta, Executive Writer for CTMfile. My guest for today is Craig Jeffery, Managing Partner and Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
Push, it's good to be talking about these topics again. Thanks for having me on.
Let's start a review of the latest Treasury news and developments. We'll start with covering two sections of headlines. The first one revolves around central bank actions that pertain to interest rate increases, and the second one focuses on payments and Libor transition. Let's get right to it. Craig, as you know, last week the US Federal Reserve, or the Fed, the Central Bank of the United States, raised interest rates by 25 basis points or 0.25% to address soaring inflation over the past year, which is now at its highest rate in 4 decades. CNBC did its latest survey called the Fed Survey, which gauged the opinions of fund managers, strategists, and economists. It put the probability of recession in the US at 33% in the next 12 months, up 10 percentage points from the first February survey. This survey also predicted the chance of a recession in Europe at 50%. Craig, given that the Russia-Ukraine conflict may escalate, commodity prices may increase, and China's lockdowns to contain fresh COVID-19 outbreaks, that could snarl freight supply chains and add inflationary pressure on the global economy. Do you think the US and Europe will slip into a recession in 2022?
The results from the survey that CNBC said, it had bumped up significantly to about a third, half in Europe, which is what you said in the beginning. So I think those are pretty interesting numbers, given it's a bunch of economists, fund managers, et cetera. And that's over a 12-year period. So when we look in the very short term, that doesn't seem likely due to prices scaling. I think as people look out long term, that can certainly change. You look at the impact of nickel. Nickel prices have more than doubled. Those go into things like stainless steel, for example. And it's really hard to find stainless steel and some of those materials across more and more industry. So it's even hitting things like the HVAC industry. It's not just your nice refrigerator that might be stainless steel. So the supply chain impacts that we're seeing across the board could be a significant contributor to that, as well as your point about China. They're still doing lockdowns, which is being a huge producer of many of these materials. It's even if people have more money and want to spend it, if the supply isn't there, the multiplier by increase in price and actual products can lead to the point where we could have 2 quarters. So while I don't see that, I'm not an economist and I don't see that in the short term due to the price pressure, there's certainly a lot of people looking at it becoming more concerned out in this 1-year time frame.
The Fed is walking a tightrope between inflation and recession. Do you think with the increase in the interest rates, 25 basis points and 5 more expected this year to 1.9% at the end of the year, do you think they would be successful in walking this tightrope?
I wouldn't want to walk a tightrope in still weather, but certainly when there's lots of winds that gust from both directions, this tightrope that you're talking about, really high inflation happening right now, trying to boost up interest rates to moderate that activity without doing too much, I think is almost an impossible task. There's too many changes going around for them to walk it well. Some real significant challenges with that. It's going to be a lot easier to read those who criticize what they're doing. Certainly it seems like they've waited a long time to start increasing rates. We did hear some news from Jerome Powell that they might be more aggressive. That certainly seems in order given the data that's coming in. And the Fed has earlier look at some of the data than others do. So you might be hanging on to the tightrope, not walking on it.
Moving forward, the Bank of England's decision to raise interest points by 0.25 percentage point to 0.75% came a day after the Fed announced its first rate hike since 2018 to combat inflation, the highest in UK in 30 years. Will this hike in interest rates rein in inflation in UK over time? And what do you think will be the level of inflation?
Yeah, I'm not going to comment on what I think the level of inflation will be because I don't know. But the Bank of England expects inflation to reach 8% by the end of the second quarter. So less than 3 months from now, they expect it at 8% and maybe go higher later in the year. This seems pretty reasonable because we've seen or reached almost that level in the U.S. when we start looking at a monthly cycle. So how long will that continue? That certainly seems like a reasonable estimate on their part, particularly with energy. I think as we come out of the winter months and before summer in much of the northern half of the globe, you're going to see fuel prices still having a major impact on inflation and rippling through the rest of the economy. So their view and concern and bumping up the interest rates that they're charging is follows along with that type of mindset.
Does the Business Payments Digitization Survey of 400 CFOs from 5 industries conducted by Payments.com and CoreCentric caught my attention. It's observed that 59% of CFOs consider payments digitization to be very or extremely important to improving their balance sheets. Craig, my question to you is, do you think that 59% is an encouraging number or should it be higher?
I like digitization a lot, so I wish it were higher, but it's a significant majority, are focused on that, and that tracks with a lot of our survey. Strategic Treasury does a lot of surveys, and this bump, the COVID bump that happened was significant, seemed to bring 2.5 years worth of digitization into 2020, and that continued through 2021. So I am encouraged by this. This automation, this move towards more electronic methods has a massive impact. And it's, I know the article talked about the health of their balance sheets. I think the impact is broader than just perhaps pure balance sheet, being able to, know and factor in when your payments are going to be made, when you're going to receive payments, but this ability to scale gracefully with automation, whether your employees are in the office or not. But it's just far more affordable. It's not just that digital transactions are less expensive than non-digital transactions, but they have less errors, which has a ripple effect of how much care and feeding and overhead is required. So this is good news. I think it's what we've seen. This is more good news in this direction. So from efficiency to balance sheet to fraud prevention and more secure methods, these are good signs. This is a bit of bright news, I think, continued bright news on the front of operational excellence and operational efficiency.
You mentioned a few benefits of payments digitization, fraud prevention, efficiency. According to you, the survey also talks about a few. What do you consider are the top 3 benefits of business payments digitization?
Most people agree that efficiency is a key driver, year over year, over a long period of time. That's always a top consideration and concern. I certainly agree with that. Less expensive. It reduces errors, which is another key driver of expenses. And because it helps with efficiency, there's a ripple-on effect of this ability to scale without hiring lots of staff. That's probably the top one. The second one, I would say, is a close tie between security and fraud control, as well as this ability to better forecast what goes on. As a finance professional, I like the impact on working capital, the ability to forecast more accurately, and we can do that better with electronic methods than non-digital methods. The shift to more digital processes allows for other enhanced security features that continue to be added into that domain. So it moves these processes into more automated arenas where more security services and features can be added more seamlessly. So I think that provides a faster and better response to the ongoing onslaught on the fraud side. So one is efficiency. Two is a tie between fraud and control and the working capital cash conversion cycle concerns.
Great. Can I ask you one more question pertaining to this survey? The figures vary by industry. So when we look at finance and insurance sector, 71% of the CEOs believe that payments digitization is very or extremely important, as opposed to industrial and manufacturing, which is at 45%, and healthcare, medical, travel, and transportation is at 60%. It varies. Why is it that it is 70% for finance and insurance sector vis-a-vis 45% for manufacturing industry? What explains this difference?
Yeah, the payments.com and core-centric survey didn't ask all the questions for the reasons behind all of that. But what I would say, and what we've seen in different industries, is industries are intensive in treasury or payment or cash conversion cycle processes at different levels in different ways. And so when you look at some of the finance and insurance sectors, they're very intensive with payments, massive volumes. I mean, they think in terms of millions and tens of millions of transactions a month, whereas if you look at, I think you gave an example of either healthcare or retail, et cetera. There might be examples, or manufacturing, where they have hundreds or thousands, maybe tens of thousands of transactions. Well, just think about the scale difference there. Multiple orders of magnitude, more payments, more transactions. So moving to more digital has a bigger impact because they're intensive in those particular areas. That would seem to be one of the biggest drivers for that difference. Still important for all of them. I mean, you had mentioned 60% versus 71%. It wasn't 20 versus 90. So it's important for everyone. It's just more important for those that are very intensive around those particular areas.
Moving on, the transition from Libor. Financial services firms are on track for a successful transition from the previously used London Interbank Offered Rate, or Libor, benchmark following the cessation of sterling, Swiss, and Japanese yen Libors at the end of 2021, as has been reported by Bloomberg. The data clearly shows that while the Libor transition is well underway ahead of the end June 2023 cutoff date, there is still more work to be done. Craig, what is going on?
Yeah, so this long-held benchmark is being sunsetted, but there's still a lot of financial instruments that may refer to it. There may not be an alternative rate. I guess we're seeing this a relatively graceful ending of this long-term benchmark rate. And I found this article on the transition from Libor, making progress, to be encouraging. Banks have been attentive, technology firms have been attentive, and corporations have been responsive. All new contracts are using some alternative to Libor. And we see steady progress, and that's removed some of the potential risks. Seems to be moving gracefully over time. There's still ongoing work to be done and care, but I just found it a good update on this progress of shifting away from the London Interbank Offered Rate.
So, Craig, finally, I wanted to see if your choice and my choice for the most important story of the past week and why is similar. My choice was the fact that when I reviewed the story the prediction by the hedge fund manager Pierre Andurand, who said the oil could hit $200 a barrel even if Russia-Ukraine conflict ends, that was, for me, the biggest story of the week. Perhaps it is different for you. I'd love to hear what is your biggest story of the week and why.
Yeah, with oil over $110 a barrel, talk about that hitting 200 certainly focuses the mind and the impact that it has on organizations. To me, that's probably one of the most interesting data points. I think the stories that I would vote for the most important have to do with some of the central bank activities, Bank of England, the Fed, and some of the other large central banks, Bank of Japan, ECB. I think those are reflective of oil prices, nickel, other commodity prices, the conflict. Russia's invasion of Ukraine and continued onslaught there and how that's having ripple-on effects. So I think the stories about the central bank actions and trying to respond to inflations is kind of a capstone of all of that. So I'm going for the aggregate answer today. I definitely agree with you that $200 a barrel is concerning and focusing of the mind.
That was an insightful analysis, Craig. A big thank you to you and to our CTM audience for joining us on this edition of Open Treasury Podcast. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.